This week, 2 reasons why the Fed may pivot and cut interest rates in 2024.
Building relationships is the way Mutual of Omaha has grown into one of the leading financial services companies in the world. Our reverse mortgage wholesale division is proud to carry on this 100-plus year tradition. To your borrowers, a reverse mortgage is more than a transaction. It's a promise of a better, more stress-free life. Our goal is to provide you, our valued client, with the best service and support possible so you can focus on helping your borrowers achieve the retirement of their dreams.
Welcome back to the Industry Leader Update. Interest rates, the pivotal factor in both traditional and reverse mortgage lending. Which leads us to a question: is the Federal Reserve's proclamation that they plan to sustain higher interest rates for longer truly a viable strategy? Well, that is indeed a big question, especially if it risks damaging the U.S. economy. However, most media outlets today are reassuring us that everything's okay, everything's on track. They anticipate that the Fed will indeed successfully curb inflation to their target rate by 2024 without plunging us into a hard recession. Now, though there is a growing consensus that the Fed will eventually drop interest rates next year, there is a split in the views on why they might cut those rates. Now, the prevailing belief is that the Fed will likely reduce interest rates in 2024 after securing a smooth economic slowdown. That is not pushing the economy into a recession with notably higher unemployment. And that would indeed be a big accomplishment, especially when we look back at the historic pace of interest rate hikes since the spring of 2022. Yet there is an alternative viewpoint being expressed by some analysts at Morgan Stanley and UBS. They foresee rate cuts next year, not because the Fed orchestrated a soft landing to slow the economy and dodge a recession, but instead, according to UBS economists, the U.S. economy could be facing a full recession, or what they call a hard landing, in the coming year. And that could force the Fed's hand to slash the overnight rate by what they project by 275 basis points throughout next year. And that's almost quadruple what the stock market has already factored in. Their forecast suggests the Fed funds rate could plummet from 5.5% to 2.375% by the end of 2024. The fact that the Fed has held rates steady in 3 of its last 4 recent policy meetings has led some economists to speculate that the central bank may be done with rate hikes. However, the Fed has cautioned that they do retain the option to resume rate hikes if they see the rate of inflation picking up. Nonetheless, the FOMC's projections, their very own, indicate a gradual decline in the Fed funds rate from the current 5.5% to 2.9% by 2026. And while the Fed funds rate does not directly influence the HECM or home equity conversion mortgage's interest rate, it does offer some insight into historical trends when you compare it to the 10-year Treasury. Now, observing the federal funds effective rate alongside the market yield of the U.S. 10-year constant maturity Treasury rate, which we use for the HECM, it shows that the U.S. Treasury yields typically move sideways in the years leading up to the Fed's first interest rate hike in the cycle. However, once the rate cycle has begun, Treasury yields historically continue to rise for the next year or two. Now, that relationship between the Fed funds rate and the 10-year Treasury, well, that has actually diverged or evolved over time. Former St. Louis Federal Reserve member Daniel Thornton argued in his 2008 paper that when the Fed began using the Fed funds rate as a monetary tool instead of an operating instrument, it created a divergence between the Fed funds rate and long-term Treasury yields. Now, that aligns with Goodhart's law, which suggests that when a measure does become a target, it loses its effectiveness as a measure. Now, we could also argue that the 10-year Treasury is a more accurate gauge of economic conditions and investor confidence versus the Fed's overnight rate. Now, investor confidence in the U.S. economy or government spending and our debt, that directly impacts the premium or interest rate that's demanded by those that purchase long-term treasuries at auction. Now, all in all, even if the Fed does pivot and reduce interest rates next year, the trajectory of the 10-year Treasury may not follow a similar path due to economic or inflationary pressures. Now, what are your thoughts? Do you believe that the Federal Reserve will cut interest rates in 2024 because they achieved a smooth landing? Or do you believe that they're only going to be cutting interest rates because their hand is forced because they find us in a hard recession? Let us know in the comment section. Also, if you'd share this video on your LinkedIn timeline, we always appreciate those of you that are doing that. And don't forget, we have a YouTube channel. Be sure to subscribe and hit the like button if you appreciate what we've done each and every week here. It really helps us improve our rankings in the YouTube search algorithm. And don't forget, we have reverse mortgage news for you each week in both audio and video format. HECM World Weekly, the nation's only weekly reverse mortgage podcast. Now, you can also find us on Spotify, Apple Music, Podbean, and of course on HECM World, so you can either watch or listen. Thanks again for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis you'll only find here at HECM World. Have a great week.